You must have heard that expecting more than 10 to 15% returns from the stock market is impossible. But that's not the case. You can achieve 30% CAGR. Yes, you can. But how? Hi guys, welcome to our channel Omega Finance. Today we're here with another informative video. We'll guide you through incredible ways on how to achieve 30% CAGR by some strategies by legendary Ben Graham and the best stocks that would help you achieve 30% CAGR. So without any further delay, let's dive into the video. So what's the science behind CAGR? Albert Einstein once said, "Compounding is also the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." While many questions abound as to whether the quote was from Einstein, the power of compound interest is undeniable. In short, compounding interest separates the rich from the broke. CAGR, compounded annual growth rate, is the rate of return needed for an investment to grow from its starting balance to its ending, assuming the profits were reinvested at the end of each period of the investment's lifetime. It measures a smoothed rate of return, and investors can compare the CAGR of two or more alternatives to evaluate how well one stock performed against other stocks in the market. Therefore, CAGR is a great way to evaluate how differently their investments have performed with time or against a benchmark. You must have heard about investors like Rakesh Jhunjhunwala or Radhakishan Damani. All these people are investing legends that made billions of dollars only via investing. Not only them, but many around the world have millions who are picking the right stocks at the right time. For instance, if you can compound your investment at an average rate of 30%, an investment of 10,000 rupees can turn into 19 lakh in the next 20 years and over 2.6 crore in the upcoming 30 years. Isn't it amazing to hear? Achieving 30% CAGR by Ben Graham's strategy. To understand the best approach and an implementable plan, we can refer to one of the greatest investors of all time, Benjamin Graham, who was the value investor who started it all. His method involved finding beaten-up, challenging firms whose shares were trading at a very cheap price. If these companies were in trouble or just perceived to be, Graham was interested as the stock prices were meager where the earnings, cash flow, and other fundamentals looked quite attractive, even if the overall investment environment didn't seem reasonable. Graham's approach was to buy these stocks and hold on long enough to make a quick profit. Let's have a look at his criteria. Number 1. Strong and long track record of paying dividends. Trying to sort out companies that have paid dividends for at least 20 years uninterrupted, or in other words, pick stocks that have been in the game of investing for a considerable time. Number 2. Only invest in big bulls. According to Ben Graham, companies with $100 million in annual sales and $50 million in public utilities is considered considerably big. Today, after adjusting inflation and other stuff, those numbers would be around $600 and $300 million respectively. Number 3. Strong financials. Graham recommended investing in companies with current assets twice that of current liabilities and debts that didn't exceed net current assets. Though this may vary depending upon the market and economical conditions, still the numbers should be close, if not exactly the same. The evidence of growth during the last 10 years is also admirable. By following Graham's guidelines and investment checklist, a beginner investor can place himself well for the future. The focus should be on companies with decent fundamentals and the ability to continue the performance into the future. Or in other words, before investing, you must be worried about selecting the best stock to invest in. Maximize your investment. High return stocks to consider. There are some stocks to buy for the long term in 2023, which can help you achieve a 30% CAGR. These include Bajaj Finance, Daulat Algotech Limited, Ajanta Soya Limited, and Indian Energy Exchange. Indian financial services company Bajaj Finserv Limited is headquartered in Pune. The company specializes in lending, asset management, wealth management, and insurance. The next stock for achieving 30% or more CAGR is Daulat Algotech Limited, which is a trading-cum-clearing member of NSE India and are in the business of securities broking and trading. Its 2-year sales CAGR is 26.03%. Ajanta Soya Limited, which manufactures vanaspati and various types of cooking oils. Besides, the company is involved in shortening products of bakeries such as fat products that are made from 100% vegetable fat and oils. Its 3-year sales CAGR is 24.64%. The next great stock to invest in is Indian Energy Exchange that operates as a power exchange. It offers an online electricity trading platform for clearing, trading, and settlement operations. Its 3-year sales CAGR is 24.74%. Now, we have also mentioned Ben Graham's way of investing earlier in this video. However, if that doesn't work for you, no need to worry. Here's another quick and detailed guide on that topic so you don't feel left out. Stock Picking Guide 101. Step 1. Start research. You can do the research before investing. The research can be based on books. You can start reading the stories of best investors that how they grew their money. So as a newbie, you can start reading books by bestsellers in the investing world that are so easy to read that even a person with no background in finance can understand them. You can start with One Up on Wall Street, written by Peter Lynch, one of the best mutual fund managers. Another worth reading book is Market Wizards by Jack D.S. Schwager, which is considered an investment classic. Mr. Schwager has written multiple books in the Market Wizards series. Names of more books are mentioned in the description below. You can watch interviews and success stories of the best investors out there like Benjamin Graham, John Templeton, Thomas Rowe Price Jr., and John Neff. Step 2 is reviewing as many financial statements as possible. Once you've mastered reading the company's financial statements, you can understand investment strategies. This can be achieved after you've researched stock investment strategies. You should understand terms like revenue, operating expense, and net income to shareholders. If you understand these financial terms, bravo! Now you're ready for the balance sheet and statements of cash flows. The balance sheet gives you a snapshot of what a company owns, what it owes, and how much capital it has put into it. The statement of cash flows gives you an idea about a firm's cash inflows and outflows during a given period. So reading companies' financial reports helps you excel, and you would be 90% ahead of investors who invest in the stock markets. At this stage, you need to do financial analysis efficiently. Step 3. Finding reputed and undervalued stocks. This is one of the crucial steps while investing. You need to find a company that perfectly suits your investing plan and strategy. You should emphasize many industries instead of one. Also, it can be your field of competence or other fields you're concerned about investing in. The main thing to remember is that you need to track everything in the comprehensive economy. Working on this, there are a lot of departments in the more prominent financial institutes. Therefore, you should not think you can do it on your own. Instead, it would be best to focus on examining your concentration to incorporate only a few vital industries. And of course, you should still consider individual firms. You need to look for every possible company which is best for investment. Other things to keep in mind are looking for economies of scale, discovering the companies with substantial switching costs, finding companies for convenient growth, and figuring out competitive advantage. You can analyze a company by calculating its price-to-earnings ratio, which is earnings per share in the last year divided by the current stock price. If you successfully identify 4 or 5 multi-bagger stocks, you can quickly achieve an average annual growth rate of 30%. The next step is diversify, but not excessively. If you want to grow your money at 30%, you can't get that by investing it randomly in 30 or 40 stocks. So you must be continuously diversifying by investing only in 5 or 8 different stocks to be safe. During this, you need to make sure that you select the best stocks that you consider can be multi-baggers in the future for you and keep the number of stocks in your portfolio at a maximum of 10. The 5th step is keeping yourself updated with stock market updates. You can choose different good websites you can trust so you can make sound decisions regarding your investment. For this purpose, you can get 24/7 updates from online news sites such as Bloomberg, Barron's app, MarketWatch, and the Wall Street Journal. You can also use RSS Reader, which is a rich summary site reader. You'll get your news customized in one place without irrelevant stuff. Also, you can sign up for Google Alerts. For example, you want to read updates about the current state of the stock market. In that case, you can have Google send you a daily summary of the articles, photos, and videos posted regarding your topic of interest. If you can't spare time to read the news, most news sites enable downloading a news ticker that brings the main headlines to the bottom of your computer or desktop screen. In this way, you can keep surfing the internet or doing your work and be able to look down now and then for new updates. Signing up for some podcasts is another significant way of staying updated and listening to expert opinions. The last step is being consistent. Once you have made the plan and selected the approach to implement, you should be consistent with your approach and do your hard work in it. If that approach doesn't work for months, you can alter it with another effective one by doing your deep research again. Do remember to stay calm during such times, as these times are the easiest way to destroy your wealth. Instead, stick with one approach and try to follow it during all times. Good or bad, you will see that you would have made much better returns in the long run than most investors who listen to tip sellers on social media or TV channels. To gain more info on money management, you can refer to our video on The Psychology of Money by Morgan Housel. The link is given in the description below. So what do you guys think about this video? Please share your reviews about what you think about the video down in the comment section. Till then, goodbye.